good to see you. You know, it's hard to believe that our firm has been working with you guys now and covering you for over 25 years. But not all of our viewers may know a lot about KBS and what you do. So can you give us just a little overview of what you do in terms of serving both institutional and individual investors?
Well, really since 2010, we've really gravitated towards high quality, mid-rise, high-rise CBD office. And we saw a change in the marketplace in 2010, and so we've just been really fortunate to have those properties in our portfolio. And so we are looking at risks in marketplaces, and the greatest risk that we have and we've experienced is development. A tenant would rather be in a new building than a 10-year-old building, 5-year-old building, or a 15-year-old building. And so we avoid markets where there's a tremendous amount or a risk of tremendous amount of development that can compete with our existing properties. But we buy assets that are multi-tenant assets. We avoid single-tenant office buildings.
And why is that? What's the philosophy behind that?
Well, we think there's a very large hidden risk. There was a time period a decade ago, really in 2011, 12, 13, in which funds would focus on single-tenant buildings. And the attractive feature is that it doesn't take much to manage one tenant. And so it could be a $60 million building, and the tenant could have 8 or 9 years left in the lease, and it may look like a very low risk. The lease could have annual adjustments, so there's growth in the income stream. But the hidden detail is that on that situation, every year that building's declining in value. Because as it gets closer to that lease termination, that lease expiration, then the probability of that tenant completely vacating the building within the next 2 or 3 or 4 years declines. So go to my example where it's an 8-year property. Well, 4 years later, if that property needs to be sold, that sale price is at a discount because there's a chance 4 years after that date, the building could be vacant.
I mean, what are some of the characteristics of a market that would have that? Why would one market have less development potential than another?
Well, a perfect example is the city of San Francisco. There's a limitation on how much square footage will be approved by the city of San Francisco, by the building department for new development. Here we're in Newport Beach, California. In Newport Beach, California, any office building above 40,000 square feet for approval for the building department of the city, it needs to go to the residents of the city to approve to make sure that that building is not, the traffic doesn't have a negative impact on the community. So as a result, there have been very few office buildings built here. Recently in Denver, Colorado, there have been a number of office buildings. They're moderate sized, smaller buildings, but a number of buildings built in Denver, Colorado, just because the availability of land, the size of the tenants, they're tenants that are growing and successful, they need more space, they'd rather move into a new building. So they'll plan to move 2 years, 2.5 years later. And so it's pretty easy to monitor the anticipated development opportunities for other developers in 24 or 36-month period of time.
So 25 years is a long time. How has the commercial real estate market changed over that time from your perspective?
And you and I will agree on this. It's just the information available to the investor. You know, when we first got in business, you go back to 1985, 1990, I think the consensus was the capitalization rate for the valuation of a good asset was probably in the 7% range, maybe 7.5%, maybe even 8%. And that was directed by the pension funds. The pension funds had a huge influence on the market, and I think today they have an influence on market value. But at that time, if you think back of what materials, what information did they have to support their investment in Chicago, downtown Chicago? What type of reports did they have? Well, they had a report maybe from the investment broker who was selling the building, giving them market information. So that data is conflicted, right? It's a marketeer, somebody's marketing their property, so of course it's rosy. Right. Well, today, there are 3 or 4 or 5 very talented, sophisticated real estate companies who are preparing information, preparing reports on markets. And that report may not be telling us what's in the market today, but they may have information which is only 90 days old. And so I think that the pension funds are comfortable with a lower initial risk because I think it's a lower return. They know more about the market, and they have a comfort level that their projections for return on those individual investments for the next 24 or 36 months are more accurate.
Now, what is it that they're seeking, and how do you deliver that when you're buying existing property?
Well, we found that nearly a decade ago, or really 2010, 2011, we saw companies value their employers really at a much greater perspective. And so, and we applauded that. We thought that was really great. And so 10, 15 years ago, if a company was looking to lease 20,000 square feet of full floor in a mid-rise building, 20 years ago, the question would be, 15 years ago, the question was, where does the CEO live, right? Where does the CFO live? Because we want to have this building so it's convenient for them. They don't ask that question anymore. They say, how many employees do you have and where do they live? How do they get to work, right? In Portland, Oregon, we have a building, right? So we bought this building and we put in 200 bike racks. If you can imagine, 200 bike racks in the building, the tenants absolutely love it. So what we found was during this time period is that tenants are gravitating to buildings that their employees are proud to be in that building. They're proud to be part of that. So we may take a building that's a 20-year-old building, or go to my Portland building, for example. We had pretty much dead space on the first floor. And so we put amenities in that building to try and make it like a new building, try to make it a better building for the tenant. So even though it's a building that, this building is a 30-year-old building, to have the amenities in the building just like a brand new building.
And what would some of those amenities be today?
Well, it may be something where we put in, some type of a food service in the lobby, or, something that we have major conference facilities in a high percentage of our buildings. So if a 5,000 square foot tenant goes into a building, they may have 20 employees or 15 employees, but occasionally every quarter they have a meeting, a board meeting, and they have 20 people or 30 people in that meeting. So they're stuck. Do they rent a room down at the Marriott Hotel, down the street? So what we do is we take space, which may not be the most desirable space in the building, and we'll build conference facilities. So we'll build a conference room for the building, and that'll seat 40 people. We'll have smaller rooms available to them. So we put amenities like that in the building. We have buildings where we have exercise facilities. Again, go back to my example in Portland. We put in a full men's, women's locker room, brand new, in that space that they can come in, they can ride in, and then we have exercise facilities, exercise room areas in that same building. Again, it's a 30-year-old building. So we're competing with that brand new building.
The market you're serving has changed. The nature of commercial real estate has changed. The amount of information available. How has your operating model changed over time?
We're unique in our structure. Back in 2001, we were structured just like I think every other, or the majority of the investment managers I knew, in that we would have a portfolio manager run the portfolio, and traditionally that portfolio manager would be in a position in which they ran that portfolio. So if it was an allocation of $500 million, it was $500 million, and there was going to be an $900 million portfolio, $1 billion portfolio. That portfolio manager ran that portfolio, but also was responsible for the relationship with the investor. What didn't work with KBS is that relationship is Peter Brent and my responsibility. So when there's a question, they may call our the chief accounting officer or asset manager. But if there's bad news, I take it to them. If there's something that we need to change, I take it to them. If there needs to be something that needs to be clarified or explained, I go to their office. I don't send somebody. Peter doesn't send somebody, he goes. So that model didn't work for us. So, years ago, almost 20 years ago, we changed, and we're so market focused because we're buyers and sellers. I want to know all the markets. We went to a regional structure, and we have 3 regional presidents. And their focus is knowing every market and sub-market. We study 57 markets throughout every month we have a report, and then 127 sub-markets. And it's the regional president's responsibility to know those markets and know what's going on in the markets.
The primary connection with the client, the accountability of the client, flows from you and Peter. That's pretty unique. I mean, I haven't seen that with other real estate investment management firms. And yeah, they're all client-centric and they all care about their clients and that sort of thing. But I've never heard anybody say, I as the CEO of my firm, or I as the founder of my firm, are the one that ultimately is responsible and accountable to the client. What's the philosophy behind that?
Well, that with a pension fund, that board of trustees is putting trust in Peter Brand, Chuck Schreiber, and our team, right? And we're going to them with a business plan and a recommendation to invest their dollars, which are retirement dollars, right, for their retirees. Most of them have a real estate team or real estate staff, at least a chief investment officer, who's recommending us. And so I've taken upon it's my responsibility to, let's say there's a head of real estate at a larger public pension fund. It's my job to make him look good. It's my job to give him all the information that he needs for his quarterly board meetings. It's my job to if we have an issue, is to get to him as soon as I can, even to pick up the phone today and call him and tell him that we've lost a tenant, or tell him something happened, or the loan didn't close, or our disposition didn't close appropriately, or some negative, to just tell him, give him a heads up before sending him a letter. We just value that trust. We value that confidence. So even on our retail side, I've had investors who invested $50,000, where somebody may say, well, would you take time with a $50,000 investment? That $50,000 investment may be more important to him than pension funds giving us $200 million.
One of the conundrums that's been kind of plaguing the business for a long time is the high cost of distribution. And you guys have actually, as I understand it, have come up with KBS Direct, which is a way for individual investors, either through their registered investment advisor or on their own merit, to invest directly in your programs without any upfront fees. That's kind of a revolutionary approach. What sparked all of that?
Well, we've been in the retail side of the business since 2005. And there have been changes in that business. There are changes in transparency, in I believe the liability for the rep, for the broker dealer, and so there's been just such great technology over the last 10 years to give investors an opportunity, or registered investment advisors an opportunity to really ascertain the appropriate investment for their investment. What type of risk? What type of yield? What type of return? What's the timing? What's the various strategies? And so Peter and I came up with the idea of creating a fund where there is not a commission paid to a representative, and there are no reimbursement for origination costs, which is standard. That cost is going to be $2, $3, $4 million. Typically, the sponsor gets reimbursed. We wrote the check, and we're not being reimbursed. As well as there's no upfront cost, there's no acquisition fees, which is traditional in our business. So what we did was we believed that we have the opportunity, so we did it, to be the first institutional investor to create a fund without any upfront load, without any upfront cost to the investor. So if the investor invests $100,000, that $100,000 goes right into the investment, and if there's no change in valuation in the assets in a quarter, 2 quarters, in a year, on their investment certificate shows that they have an investment worth $100,000. In the traditional non-traded REIT business, if they go through that model, instead of being $100,000, it could be $95,000, it could be $93,000, it could be $85,000. And a lot of that stuff it isn't really completely to the knowledge of the investor. So with the technology, with our ability and size, we're able to do this. We're really proud to what I think, to have the first institutional fund for multi-properties for an investor to invest in high-quality, institutional-grade commercial real estate. And an investor can invest $10,000. Our investments are typically larger. It's open to accredited investors now. And we're just proud to be able to deliver that to the retail investor.
But one of the entities involved in this whole transaction is the registered investment advisor, the private wealth advisor who's advising these folks. And some take commissions, some charge fees, some do both. How are you aligning yourself with their interests? And they've got a business, they're advising clients. We were talking earlier, and you were saying you really think the RIAs provide a huge value to the client by providing with advice, because most clients really don't they spend their time making money, the way that they make their money, not necessarily in investments, and they need help. How is this helping the RIA?
The majority of the RIAs have a fee-based account, so their clients are paying a fee. It's an annual fee. It's a calculated annual, but it's paid quarterly.
On assets under management as opposed
Correct.
to commission.
On the overall portfolio, and they're running a portfolio, so they may be invested in securities or bonds or multiple product type, and real estate may be 20% of their portfolio or some smaller share. So they're getting a fee for running that. I think KBS, when we started in the retail business, I think we had the largest support from the registered investment advisor because of our institutional nature, because of our real estate background. So I think that we complement them because, first of all, I think we have great data for the investment manager. I think that advisor has access to tremendous market data from KBS, one-on-one. And we'll respond to them just like I talked about and respond to the $50,000 investor. We'll give them everything we have. So I think we provide great data for them to ascertain whether our fund is the right fund. And it may not be the right fund, but whether it's appropriate for their investor. And I just think the fact that we're institutional, the size of the company, the alternatives that we have, I think it's a great product, and the response since creating this strategy has been tremendous from the registered investment advisors.
How knowledgeable would you say the registered investment advisor community is about commercial real estate? How capable are they assessing what you're actually offering them?
Well, I think it's very challenging for them to know if, for example, if our current assets in the growth and income REIT, which has overall value around $200 million in 4 assets, and there's 1 asset in Houston, office building in Houston. And so if there's an advisor here in Southern California, maybe he hasn't been to Houston in 5 years, maybe never been there. So for him to determine whether the risk-adjusted return in a market that is so influenced by the pricing of oil and what happened 4 years ago, 3 years ago versus today, that may be really challenging for him to have the perspective that I have in the marketplace. But I think what we are able to provide for them is that direct support. I think that we have a team here that can provide ultimate information on real estate, on commercial real estate. I think the advisor's job is a very, very difficult job. It's a job that I don't want. I don't want to study a dozen different product types to determine whether we should be in that product during the fourth quarter of this year. And part of it is my mentality is we're sellers. If we're in a portfolio and we have an asset and we have a portfolio of 20 assets and we have a property in a market that we think there are new risks that are surfacing, we'll sell that. So maybe the RIA doesn't have that same perspective of selling it.
What do you think the RIA needs to know in order to make good recommendations about choosing product sponsors and like yourself? What is the knowledge base that they need to understand? Do they really need to understand the real estate at the granular level, or do they need to know something about manager selection?
I think both. I think they need to look at the sponsor. I think they look at the sponsor, how long they've been in business, their total exposure to the marketplace, the alternatives that they have, their current portfolio, current team, the tenure of their team. I think also that they need to have a sense of real estate. I mean, we talked about single tenant versus a multi-tenant building. One element that a lot of people who initially invest in real estate, they invest in a partnership in one building. Okay, so what if you and I are each going to put $100,000 into my brother-in-law's multi-tenant building up here, right? And so we decide we're going to go in it, we invest in it, and so we're getting a 5% or 5.5%, 6% return. It's great. And he calls us in October a year from now, and he says something happened in the neighborhood. We paid $20 million for the building. We're going to sell it. We're getting out of $20 million. I mean, our response isn't good, right? Wait a second. I don't like that. I mean, I'm getting a return, but I went through all this exercise to get a 5.5% return on my money for it, and now I have to do it again. That's not a great. In our portfolio, if we get into a situation out of 20 buildings and we have a risk, and we would sell that building in a heartbeat to eliminate the risk. And it doesn't have a negative impact on the investor because we'll go buy another $20 million building that has an opportunity long term. So one thing I emphasize with RIAs is the multi-building portfolio and the diversity and the opportunities to manage that gives us such an opportunity to eliminate risks. So I think that advisor really needs to have an overall perspective of what's the acceptable level of risk and strategy for investments for their clients.
Some RIAs, not all, but some, really shy away from illiquid products. They don't like things that are not traded or priced daily. And what do you have to say to somebody like that that's concerned about the liquidity or relative illiquidity of the investment?
Well, a liquid investment may be appropriate for their client. You know, there are people with our funds in which we're not going to liquidate the funds for 3, 5, 7 years. And if somebody thinks that they're going to need that money in 5 years, I said, do not invest in this. This is not an investment for you. The opportunity may be in a traded REIT. So just starting out, the traded REIT, the dividend will traditionally be lower than the dividend that we're paying out. It has to be, just because of the structure of the fund. Also, the return that's being offered are going to be influenced by so many other things other than just the performance of the real estate. So we have redemption available. So if somebody invests their $100,000 and they need money in 6 months from now or a year from now, we provide an opportunity for some redemptions. I tell them, don't plan on that, because that could change. Any of these funds that are real estate funds that are, they call them NAV funds, net asset valued funds, that may be valued daily or may be valued quarterly or monthly, that are not traded, but they're suggesting there's 5% liquidity every quarter. Well, if the market goes down, what if 20% of the investors want to liquidate their position? That investor may need to wait a year and a half to liquidate their position. Or the board of directors can determine that it's damaging to the REIT to liquidate assets in this declining market, so they'll discontinue that redemption. So there's not a guarantee in that. So that advisor really needs to educate themselves on the alternatives of running those funds. And if they need that money, if they need those dollars, those invested dollars in 6 months or a year and a half, 2 years, they need to focus only on those liquid assets, and is basically limited to traded REITs.
How is what KBS Direct is offering similar and dissimilar from a traditional crowdfunding, or if there is such a thing?
Well, it's similar in that an individual can invest through KBS Direct into the growth and income REIT. So they can make the direct investment. They don't need to have a relationship with an advisor. In many cases, I suggest they have an advisor, but and some are very, very knowledgeable about the real estate field. So they're capable of making these decisions. So the crowdfunding, though, is really being created. If you look at those opportunities, those are typically one building, one asset. Many of them are development projects. And so there is some information about the sponsor. I don't know that I've seen opportunities that give you great market knowledge, market data on market rents, competing buildings, neighborhoods. And I find that those websites people are looking at a number. There'll be ads where there's somebody in 2.5, 3 years, a period of time, they're looking at 2x, or you invest $100,000, you get back $200,000. And people will be investing in that. And I discourage that. I say, you better get more information. You better get more data from the sponsor. Call the sponsor. Ask them for information in the marketplace. I'll invest in that if I think that's a good return.
If you were going to look back on your career, what would be probably the most memorable office transaction that you were involved in over the years, and what made it so?
We bought a very, very large building a number of years ago, and this was in 2010. It was a very difficult market. Interesting, we have a building, we have an office in Chicago. And so, and we were buying buildings that were, 20 to 40, $50 million buildings, maybe $100 million buildings. And this is a time when we were gravitated over to really high quality Class A buildings. And so our asset manager there I went to meet with him, and he said, I got to show you a building. Now we were going to lease new space, right? We're going to move our office. So I already had the office plan and the budget, and so I think we're going to go look at the building we're leasing. And we walked down, and we go into this building's on Wacker, and we look at this. He said, here it is. And I'm thinking, what in the world are these guys doing paying the rent? We're not going to build, we're not moving into this building. This is too expensive. So on the way back to the office, he starts explaining to me that this is a target for an investment. It was a huge building. And at that time we had funds available, and we were able to buy it in 2010, a very, very difficult market. It was very difficult to finance assets. And we had a seller that was at the time, I think it was the premier office development for the past 5 years. It was just a sensational building. And so we have a great relationship with the seller, and we still do. We bought the building from them. It was less than 90% occupied. The timing was crucial, so they trusted us. They trusted that we were going to close, and we were able to close the transaction. And then over a 3-year period of time, the market stabilized greatly. Financing became available. We actually received an unsolicited offer, so that's why we got into the discussion, and so we went ahead and sold the asset for a great return to our investors.
So the only other thing that I noticed that you get really enthused about is the people who work for you. How do you feel about the people who work for you, particularly the guys that have been with you since the very early days?
We have such great tenure. And I joke when I meet with them. It's because somebody will say, "Well, why are you have people who've been with you for 10 years or 15 years?" But we have a strategy here, and some of it is really twofold. Number one is I allow the team leaders to run their team, right? And I have a policy in my office is don't bring me a problem without a recommendation, right? Because if they bring me a problem and I have to solve that problem, which I can, I may not solve it as well as they could, but I can solve it. Well, if I do that, I don't need that. We just have great people. The people who are so dedicated to KBS. I get in here at 6:30, 6:45 in the morning. I haven't made coffee for 2 months. There are people who are here just dedicated, focused, and committed. We have an environment here that has such great talent that people who work here just love the people who are sitting next to them. They love to be involved in investment strategies with other analysts and asset managers. They're just so passionate, so dedicated. I'm just proud of everybody who works here, each person.
Now, you've been in the business for a long time, 30 years or more. What's the best career advice that somebody's given you over the course of your career?
Really two that I think of. And one was a real professional that I was able to join nearly 30 years ago. And he really taught me the importance of being a perfectionist, because I wasn't at the time. And I'd allowed people to make even grammatical errors, even their dialogue, even in their presentation, even in dates on summaries. And that was really important. That was really, because it really took me up to the institutional level. And so now I'm a perfectionist, and so I run that through the company. I'm not anybody's proofreader, right? It bothers me when I see something, an email that comes through, and there's an error in it, right? So should I edit it, especially if it goes to our board members, right? I'm really sensitive to that, and even going through the numbers, because if the date's wrong, how do I know the IRR calculation is right? How do I know the annual yield's right? How do I know the assumptions are right? Everything's got to be perfect. The other thing is really tenacity, and I've always been a little tenacious, but I've been able to really get guidance from others who are just really tenacious, and they're just looking at sitting here today, and their vision is, what's this going to be like 12 years from now? And it's not, how much money we're going to make this month or next month or even this year, but really, what's this company going to look like in 2030, 2025? What are our employees going to look like? And so to be able to create that vision is something that's really, really exciting. That was a great lesson.
Thanks for taking the time with me today, Chuck. It's been nice catching up.
It's a pleasure having you in our office. I'm honored to spend time with you.
Yeah.